Hi guys, welcome back to the YouTube channel. In this video, I'm going to run through 3 property investment mistakes that I see landlords and property investors make when it comes to their taxes. So I'm a chartered tax advisor. We run an accountancy practice in the UK. So we work with hundreds of accountancy clients, property clients, all across the globe. So we have a good insight as to what we see people doing well, where we see people doing better when it comes to reducing their taxes. And these are probably the top 3 mistakes that I see people make on almost a daily basis. So the first one, number 1, is basically investing in the wrong structure. You'd have thought at this point that wouldn't be possible with all the information that I'm sharing on YouTube, TikTok, Instagram, and anywhere else. But unfortunately, I still see people coming to us where they've got the wrong structure set up. They might be employed full-time and have 15 buy-to-let property portfolio, and they don't know that the options are available. They're just happily paying their taxes and thinking, okay, well, I've not got much left. And they're unaware of the other options. It might even be kind of people doing service accommodation, pulling money out of, I've even seen it, people pulling money out of their trading company. So these are always people that are coming to us because, of course, you never get this kind of service with JSM, but we've seen people literally have their accountants say to take dividends from their trading business, so pull out about £100,000, whatever it might be, into their personal name, pay income tax on that, to then directors loan it to another limited company to buy property in. And it's mind-blowing, the fact that people get this kind of advice and they have these inefficient structures set up, because that is very, very basically destructive to them accumulating their wealth. Having to pay that about 40% tax hit before being able to invest in property, that's an extra property. If you think how that's going to compound over 25 years, that will make a massive difference to their level of wealth. So that's the first thing, is get the right structure set up. Of course, you probably don't know what the best structure is, so book a consultation and get advice from somebody who does. Number 2 is basically paying too much stamp duty. So especially if you're investing in commercial property, buying lots of properties, commercial property, development, stamp duty is a very complicated area, and there's so many different reliefs available, whether the property is uninhabitable, whether the property classifies as commercial property, whether it's land, and there's so many different avenues that you can go down. End of the day, you need to speak to your solicitor, because I guarantee you, if you look at your engagement letter with your solicitor, it will say that they do not provide advice in relation to stamp duty. So for every single transaction that you do, speak to your accountant or your tax advisor, who will be able to see if there's any opportunities available to reduce the amount of tax that you pay. So many people think that their solicitor is going to help them advise on stamp duty, but this is absolutely not the case. And stamp duties, conveyancers, they're not stamp duty specialists. They don't know the quirks. They don't know multiple dwellings relief. They don't know when commercial rates apply. So ultimately it's not their fault, but so many people kind of have this expected level of trust and service from their solicitor that they're going to help with stamp duty, but the truth is that they don't. Have a look at your engagement letter with your solicitor, because all of them may say they do not provide tax advice, and you have to seek that elsewhere. That's number 2, is basically paying too much stamp duty because you're not getting the advice that you need. The third and last mistake that we see people make is not claiming the right tax reliefs. So especially at the minute, so many landlords, even a lot of our client base, have actually changed the business model with the higher interest rates, with the rents not increasing where they need to be. So it's actually service accommodation, furnished holiday let is a massively valuable opportunity at the minute for a lot of landlords. They're pivoting their business model and changing to furnished holiday let, service accommodation. But what they're not doing is basically taking advantage of the tax benefits of serviced accommodation. So a lot of people don't know this, but serviced accommodation, you can claim something called capital allowances. And with the capital allowances, you can typically claim, I'll say this loosely, but it could be anywhere from 10 to 30% of the property value, so of the actual property, full property cost, so £200,000 if it's a flat or house, whatever it says, of the full purchase price, the full market value, you can claim as capital allowances. This is for the integral features, so the fixtures and fittings, basically all of the mechanics that go in basically behind the house that you can't usually claim, or you can never claim with a residential buy-to-let property. You can claim that as a tax write-off. So if you purchase a property for £200,000 and we can help you get a £40,000 capital allowances claim for all of the fixtures and fittings and integral features within the property, that's £40,000 of tax-free profit that you can earn in your business. So if that property's netting you about £10,000 a year, you will not pay a penny in corporation tax for 4 years. So £10,000 over the 4 years, £40,000, that's until the capital allowances are fully utilised and you pay any tax for that particular property. So that's a massive one. So make sure that, especially when you're trying different strategies, if you're looking at property development, land remediation relief, there's so many different unknown and basically like unknown and basically very unpopular tax reliefs that go swept under the carpet because your accountant's not a property tax specialist. You don't know about them. And of course, you're a property developer or you're a property investor. How should you know about them? Of course, you're going to learn some of them from watching these YouTube videos and working with me. But ultimately, if you're with another accountant who doesn't understand this stuff, the chances are you'll probably be paying too much in tax. So that's the third one, is make sure that no matter what strategy you're doing, you're getting educated in all of the different reliefs that are available so that you can say, okay, can this one apply? Can this one apply? Can this one apply? If no, fantastic, at least you tried. But if yes, even better, because you'll be paying less in tax. So that's all for today's video. Are you guilty of any of these 3 common mistakes? Have you made these in the past? Do let me know in the comments. Otherwise, please do give this video a big thumbs up and smash that subscribe button. See you in the next video.